So we think at the beginning of 2019, there's a clear trend, divergent trend between emerging market corporates and US corporates. So US corporates are re-leveraging, EM corporates are deleveraging, and we've seen this is the case for the past several years. So on top of that, EM macro picture looks much more stable than it was in 2018. Obviously we had the crisis in Argentina and Turkey. Now those countries are in a much more stable macro picture. Their trade balances have adjusted. They're going to be in recession in this year, but this is what we've expected. We've got countries like Brazil where the political environment is so much stronger than it has been in previous years. It's tough to push through reform in Brazil, but they're improvements in the economy that we see. So I guess overall the EM macro picture, I can't stand here today and say it's the strongest, a really, really strong year of growth in EM in 2019, but we think relative to some of the other markets, relative to the US where they've had strong growth in 2018, can that be repeated? I think the market questions that. And then, relative to the Eurozone where actually, it's been a real struggle to have growth in the Eurozone. So actually, EM looks relatively stable compared to other economies. The risks are, so at the beginning of the year we would have said, the main risks to our market are the Fed, the Chinese-US trade wars, or the strong dollar. These are the three risks. We've kind of had, the Fed, their decision in January not to raise interest rates, it seems like for the next sort of 6 months or so. So that market kind of is a clear signal to us that it's time to take a little bit of risk in the market. And in Chinese trade wars, we feel like we're closer to a deal than we ever were in 2018. We think 2019, there's a key meeting in March at the end of the month. We think there's going to be some sort of deal between China and the US. We think that's ultimately what both leaders want to happen. And for the strong dollar, will that persist? There were some temporary stimulus measures in the US economy in 2018, which are not likely to carry over into 2019. But we will see. We really need the Eurozone to pick up for that strong dollar to really for the dollar to be weaker. But that will be the thing. And the other thing is just the risks, I suppose, are we always worry about election risks. And in 2018 there were some key elections in Brazil, in Mexico. These are big parts of the universe which drive sentiment in general towards emerging markets. Whereas this year we have an Argentina election that we're very aware of. There's a clear risk there, but it's not a main for us in emerging market corporate debt. It's actually quite a small portion of the index compared to these Brazil and Mexico. So we don't think it's going to be we know it's a risk, but it's not a main driver of sentiment towards the asset class. We obviously don't think we think the asset class is often quite there's misconceptions in the financial press. Our own newspapers, our Financial Times, can be quite negative on emerging market corporate debt, and it always comes down to the risk that these companies are borrowing in dollars, but look how weak EM local currency is. So how can they possibly repay their dollar debt? And there are a lot. We always say for a company there has to be two things happen. The EM local currency is weak, plus the company has a very, very levered balance sheet. And if you have those two things together, then yes, that means that that could have risk on payment. But actually, what we see in emerging markets is companies, because they know their currency is not stable, they operate with very, very low leverage. They have very conservative management teams. They manage their balance sheets very, very conservatively, and this is sort of misrepresented. So there's no, look at the default rates in 2018 in emerging market corporates, 1.4%, despite what happened with local currencies. So we certainly think that the risks in emerging market corporates are much less than investors think, and often a corporate can have a higher quality credit rating than the sovereign that it's in. So in terms of credit spreads, we're not at the lows. So the lows in credit spreads in emerging market corporate debt were at the beginning of 2018. So in February, I think 2018, we had lows in terms of credit spread on the index. And now we are not anywhere near that. We're still about, say, 100 basis points off. We're at a yield of about 5.5%, even more than that actually, about 5.75%, 5.8%. on the index. Credit spreads are around what I would say on single Bs they're about 350. On single Bs are about 580. On the double Bs are about 350. And we definitely think there's another tightening that can happen because of the strong fundamentals in the asset class, and because there's not a lot of new supply. There are flows coming into the asset class from investors. We've seen that so positive. But in terms of supply, there's not a lot of new issuers, so that demand and supply balance is quite favourable for spreads to tighten. We certainly think there can be another sort of 50 basis points or 100 basis points in spread tightening from the lows of towards the lows of last year. Generally, what we favour is companies that come from countries in the double B, single B space. Quite often these companies, so for example in the US, if you have a single B company, you think, okay, that company is going to have a lot of credit risk, it's very levered. Whereas in emerging market corporates, what you get is companies that are maybe in Argentina, for example, which is rated single B, or in Ukraine, which is rated single B. You have the rate, and the corporates are rated single B because they're, certain political risk associated with it. But the credit risk of that company is very low. Those companies are very conservative balance sheets, low leverage, and they have proven to perform better than the sovereign. Quite often, when there's been a crisis in the sovereign, there's still Ukrainian corporates which have been paying their debt, servicing their dollar debt. Just doesn't matter what's happened to the sovereign. So we like this sort of area. We're overweight high yield in our funds for this reason, because we think there's a lot of mispriced corporates in the single B and the double B space within emerging markets. And we have 50 countries to choose from. It's a very diversified index that we get to invest in. So in our fund, we manage roughly about 1.8 billion in pure dedicated strategies in emerging market corporates. And I think traditionally we find that a lot of our clients are from Northern Europe. So these are pension funds in Northern Europe, or high net worth clients, like fund selectors. But now we see a lot more interest in the asset class from investors that have never looked at it before. So for example, we have a lot more interest from Japanese clients, more so towards the investment grade emerging markets corporates, or even from the US. We're getting a lot of the RFPs, due diligence requests from new type of clients, I guess because yields have been so low in developed markets for so long that, and gradually as investors get educated on the emerging market corporate debt universe, that it's not as risky as you expect. It's actually an investment grade asset class. We see more interest from clients that are traditionally more conservative, but want to take a little bit more risk in the asset class. I think the nice thing about emerging market corporates and the position that we're in, that we get to influence the companies, because quite often in emerging market corporates it might be, and our process is very bottom up, we meet managers all the time, and often there's an emerging market corporate that is a private company. It hasn't listed in stock exchanges yet. It's a private company, but maybe it has aspirations to issue in 5 years' time, to IPO. And at this stage, we meet with them and we tell them that you need to, the governance standards may not be as we would expect for a listed company. It's not something, there's no red flags yet for us, but we know that there's room for governance to be improved, and we can influence them at that level. So governance is always something we're looking at where we're investing. Things like ESG is important to us. Things like environmental and social aspects are difficult to spot from the initial investment. But with governance, you can sit down with management teams and you can tell this is a good owner for a company. This is what I want to work with going forward. Their board is set up this way. So there's aspects of governance that we feel that we can influence from a lot of issuers that are issuing private companies that are issuing debt at the moment.